If you had to start investing today with exactly $0, no savings, no rich parents, no lucky crypto wins, nothing sitting in a brokerage account, what would you actually do? Because here's the uncomfortable truth nobody on finance YouTube wants to admit. Most investing advice secretly assumes you already have money. Just max your Roth IRA. Just buy the dip. Just invest $500 a month. Now look, if you already had $500 a month to invest, you wouldn't be searching how to start from zero in the first place. And this is where it gets interesting, because starting from zero in 2026 is actually an advantage if you understand one psychological shift most people miss. By the end of this video, I'm going to show you exactly what I would do step by step if my net worth reset to zero today, including the first investment I'd make that doesn't involve stocks at all. And why most beginners waste their first 2 years doing the wrong thing. Here's the thing. Investing is not about money first. It's about momentum. And most people kill their momentum before it even starts. Now you might be thinking, but investing literally requires money. Yes, but money is the result of a system, not the starting point. Let me explain. Imagine two people. Person A starts investing $50 a month immediately. Person B waits 1 year to get ready, learn everything, and feel confident, then invests $200 a month. Most people assume person B wins because they invest more. But financially and psychologically, person A almost always ends up richer. Here's the payoff before the explanation. Consistency beats intensity because investing is a behavior, not an event. Let's run the math. If person A invests $50 monthly into a simple index fund, earning an average of 8% annually, after 10 years, they have roughly $9,000 invested and about $14,000 total value. Person B, even investing 4 times more later, often quits earlier because they never built identity momentum. Here's what most people don't realize. The brain tracks identity faster than bank balances. The first dollar you invest changes how you see yourself. You stop being someone who wants to invest and become someone who invests. And that psychological shift compounds harder than interest. Now stay with me, because in a minute, I'm going to show you the exact $0 strategy I'd use today, and it starts in a place nobody expects. But first, we need to talk about the biggest lie beginners believe. The lie is that investing starts with picking assets. Stocks, crypto, real estate. No, investing starts with cash flow creation. Here's how I'd begin from zero. Step 1 would not be opening a brokerage account. Instead, I'd build what I call a $100 engine. Because here's the math nobody talks about. If you can reliably generate an extra $100 per month, that is equivalent to owning roughly $15,000 invested at 8% annually. Let that sink in. An extra $100 monthly equals the income power of a 5-figure portfolio. So why do beginners obsess over stock picks instead of income systems? Psychology. Buying stocks feels sophisticated. Improving income feels uncomfortable. But this is where it gets interesting. 2026 has made starting from zero easier than any time in history. You don't need a business loan. You don't need inventory. You barely even need experience. What you need is leverage, attention leverage, or skill leverage. Now you might be thinking, I don't have skills. Here's what most people don't realize. Skills are built through paid repetition, not preparation. When I say I'd start investing from zero, I'd invest my first 30 days into learning something monetizable immediately. Simple examples: short form video editing, basic graphic design, local service arbitrage, AI-assisted content writing, online tutoring. Nothing glamorous, because glamour delays income. Let me give you a real scenario. You learn basic editing and charge $50 per video. You complete 4 videos per week. That's $200 weekly, $800 monthly. Now watch what happens. Instead of waiting years to invest, you've created investing fuel. And psychologically, something powerful happens. You associate investing with growth instead of sacrifice. Here's the payoff. Investors who fund portfolios through growth income stick with investing 3 times longer than those relying only on budgeting. That's backed by behavioral finance research from Dalbar studies showing emotional quitting is the #1 wealth killer. People don't lose because markets crash. They lose because motivation crashes. Now keep watching, because the next step is where most people sabotage themselves without realizing it. Once money finally starts coming in, beginners do one of 2 things. They either spend it because they feel behind, or they try to invest aggressively to catch up. Both are mistakes. Here's what I do instead. I'd split my first $1,000 earned into 3 psychological buckets, not equal buckets, intentional ones. $500 becomes stability, $300 becomes investment capital, $200 becomes skill reinvestment. Now look, this isn't random. This structure removes anxiety. Financial math first. If emergencies constantly force you to sell investments, your returns collapse. Selling during stress destroys compounding. So that first 500 isn't boring, it's protection for future growth. Now here's where it gets interesting. When people finally invest their first money, they often chase excitement. Crypto spikes, hot stocks, trending sectors, because dopamine feels like progress. But here's what most people don't realize. Excitement and returns are negatively correlated for beginners. The more exciting an investment feels, the more likely it already priced in optimism. So what would I actually buy? Simple, a total market index fund. Not because it's flashy, but because it removes decision fatigue, and decision fatigue is the silent killer of new investors. Imagine your brain like a phone battery. Every investment decision drains energy. The fewer decisions required, the longer you stay consistent. That's why lazy investing works, not laziness in unnecessary thinking. Now, you might be thinking, but starting small won't make me rich. And this is where the math shocks people. Let's say you invest just $300 monthly starting today. At 8% average returns, after 20 years, you have around $170,000. But here's the twist. If you increase contributions just 5% yearly, not huge jumps, that number climbs past $300,000. The growth doesn't come from returns alone. It comes from behavior scaling. And behavior scaling happens when investing feels manageable. Now stay with me, because the next insight changes how you view starting late. Most people believe time in the market is everything. That's only half true. Consistency in the market matters more. Someone investing irregularly for 30 years often underperforms someone consistent for 15, because compounding hates interruptions. It's like pushing a snowball uphill. Every time you stop, it melts. So here's how I'd automate success starting from zero. The moment income becomes predictable, automatic transfers begin immediately. No thinking, no timing, no waiting for dips, because timing requires emotional perfection, and humans aren't built for that. And this is where psychology beats intelligence. Studies from Vanguard show automatic investors outperform self-directed active traders, despite having less financial knowledge. Why? They remove themselves from decisions. Now, let me open another loop here, because in a minute, I'm going to show you the one investment I would delay, even though everyone online says to start it immediately. But first, we need to talk about lifestyle inflation. Your income rises. Your expenses quietly follow. You don't notice because upgrades feel earned. Better food, better subscriptions, better everything. Here's the math problem. If your expenses grow at the same rate as income, investing never accelerates. You stay financially stuck while feeling richer. So I'd implement a rule. Every income increase automatically sends half toward investing before lifestyle adjusts. You never feel the loss because you never experienced spending it. Psychologically brilliant, mathematically powerful. Now, the surprising reveal. I would not rush into individual stock picking, even if I loved researching companies. Why? Because early investing success builds confidence, and confidence without experience leads to overconfidence. And overconfidence statistically leads to underperformance. Beginner investors who pick stocks too early trade more frequently. More trading equals lower returns due to timing errors and taxes. So instead, I'd earn the right to take risk later. First, build consistency, then build knowledge, then add complexity. Think of investing like weightlifting. You don't start with maximum weight. You master form first. Now, you might be wondering, when does it finally feel like progress? Here's the honest answer, around the $10,000 mark. Not because of returns, but because compounding becomes visible. At $10,000 invested, an 8% year produces $800 without extra work. That's psychological magic. Your money starts helping, and motivation skyrockets. This is why the early phase matters so much. You're not building wealth yet. You're building belief. And belief keeps you invested long enough for math to work. Let me tell you something slightly frustrating but true. The first $1,000 is harder than the first $100,000 because identity resistance is highest at the start. Once investing becomes normal, growth accelerates naturally. So if I woke up broke tomorrow in 2026, here's exactly what my year one would look like. I'd focus obsessively on increasing earning ability. Automate small investments immediately. Avoid complexity. Increase contributions gradually. Protect consistency at all costs. No shortcuts. No hype cycles. No chasing. Because here's the thing. Wealth is rarely built through brilliance. It's built through boring decisions repeated long enough. And this is where most people finally understand something powerful. Starting from zero is not a disadvantage. It forces you to learn the real engine of wealth instead of relying on luck. Now imagine yourself 5 years from now. You didn't wait. You didn't overthink. You didn't try to get rich fast. You just followed a simple system. You built income. You invested automatically. You stayed consistent during boring months. And suddenly, your portfolio crosses 50,000, then 70, then 100. Not from one big win, but from thousands of small decisions stacking quietly. That's the part nobody posts about. The quiet middle. But that's where real wealth lives. So if you're starting from zero today, don't ask, what stock should I buy? Ask, what system makes investing inevitable? Because once investing becomes inevitable, wealth becomes probable. And honestly, that's the real secret nobody tells beginners. You don't need perfect timing. You don't need genius insight. You don't need starting money. You need momentum. Start small. Start messy. Start today. Because the biggest risk in investing isn't losing money. It's waiting so long that compounding never gets the chance to meet you. And if you take nothing else from this video, remember this. Your first investment isn't into the market. It's into becoming the kind of person who never stops investing.